Hello, welcome to MoneyWiseAlpha.com, your financial freedom guide. I'm your host, Christian John Salas, the founder. Today, we're going to talk about how Bitcoin prevents fractional reserve lending. So most of the money used today comes from fractional reserve lending. So figure 1 is just a simple illustration of how fractional reserve lending or banking works. So, for example, say you had $100 that you deposited into a bank. And if they had a 10% reserve ratio, that means they could keep $10 and loan out $90. Then this process repeats. $90 is deposited in another bank and loaned out again. $81 is loaned out in another bank. So this process can repeat an infinite number of times. So just from this simple example of 3 banks, just what started as $100 of money deposited became $171 of money loaned. So this is where most of the money comes from today. Through this fractional reserve lending banking system. Now, the banking system is subtly stealing people's buying power and assets by fractional reserve lending and through inflation as well. So, famed economist John Maynard Keynes once said this about inflation, deficit spending, and fractional reserve lending and taxes. By this means, government may secretly and unobserved confiscate the wealth of the people, and not one man in a million will detect the theft. So fractional reserve lending allows banks in a very subtle way to loan out much more money than they currently have in reserves and burden people with debt and long-term inflation as well. And it's also a means by which they transfer hard assets to themselves. So the modern banking system is based on an illusion. Banks simply create this fiat currency out of thin air by using their printing presses, or nowadays, they simply just type in some numbers into a computer screen, right? So this illustration shows the illusion of the modern banking system. So this fiat paper money is created by a state bank, which is enforced by the government through guns, and they create this fiat currency, this paper money out of nothing, out of just thin air. And people work their entire lives to earn money so that they can pay off their debts, bills, etc. And the bank, they simply just create it out of just nothing, out of just thin air. And this act of creating more money, every time they do this, they cause inflation and they put more and more people into debt. So this is a really bad system. And if in a sound monetary system, which we had in the past, which was based on a commodity-based system, such as when we were using gold or a gold standard, fractional reserve lending, deficit spending, and inflation is impossible. It's also much more difficult to burden people with long-term debt and inflation because of this, if we were in a sound monetary system. So Bitcoin will turn us to a sound monetary system. So in our current digital era, Bitcoin and other cryptocurrencies act as a type of digital gold. So Bitcoin and other cryptocurrencies make peer-to-peer transactions and, more importantly, decentralized creation of money possible, similar to when our ancestors were using actual physical gold for trade and barter, right? So fractional reserve lending, deficit spending, and long-term inflation will be prevented if there's mass adoption of Bitcoin and other cryptocurrencies. So, for the full version of this presentation, please visit MoneyWise Alpha. Please like and share and subscribe to this channel as well. Thanks for your time and have a wonderful day. Thank you.